Hello students. Today we will be discussing some of the concepts related to bond valuation, which is in unit 3. So welcome to this video lecture students. So this module is concerned, it's a blend of theory as well as problems. So today we will be understanding first initially some of the theoretical concepts related to bond, equity shares as well as preferential shares. Then followed by that we will be solving the problems. Well, students, in this unit, we will be, solving the problems related to valuation of securities, bond and fixed income instrument valuation, problems on valuation, bond pricing theorems we will understand, students. Then duration of bond and immunization of interest rate risk term, structure of interest rate, then determination of yield curves, valuation of equity and preference shares. Then we'll even understand a very important model called as CAPM, that is capital asset pricing model, and we'll even solve the problems related to CAPM, that is problems on even valuation also. Okay, before going to the problems, first we'll understand the concept of bond. So it refers to the instrument which obligates the issuer to pay. See students, a bond is a contract that requires the borrower to pay the interest income to the lender. It resembles the promissory note issued by the government and corporate. The par value of the bond indicates the face value of the bond, that is, the value which is stated on the bond paper. Generally speaking, students, the face values of the bonds are or will be 1000, 2000, 5000 and alike. Most of the bonds make fixed interest payment till the maturity period. This specific rate of interest is known as coupon rate. Coupons are paid quarterly, semi-annually and annually. At the end of the maturity period, the value is repaid. Now, if you ask us like, sir, what about the risk involved in bond? See, generally stocks are considered to be risky, but bonds are not as much risky compared to the equity market. See, bonds, they have risk, but bonds do have risk, but the nature and types of risk may be different. The risk associated with the bonds are like interest rate risk, default risk, marketability risk and callability risk. Okay, we'll continue some of the concepts related to bond. This form of investment represents the most usual way of borrowing by a company. It is intended to suit the investment needs of a risk and steady returns coupled with the safety of the principal sum. FIs, that is financial institutions, banks, are offering attractive bonds. It includes both debentures and bonds, which provides a fixed percentage of return. Now, bonds features also are there, students. That is very important to understand. So first we will understand the nominal principal or face amount, the amount on which the issuer pays interest and which has to be repaid at the end. Then issue price, the price at which investors buy the bonds when they are first issued, typically 1000 rupee, what I mentioned, 1000. Then the net proceeds that the issuer receives are calculated at the issue price less issuance fees times the nominal amount. Then maturity date, very important to understand, students. The date on which the issuer has to repay the nominal amount. As long as all payments have been made, the issuer has no more obligations to the bondholders after the maturity date. The length of time until the maturity date is often referred to as term or tenure or maturity of a bond. Then coupon. See, normally in the problems, we speak about the coupon interest rate paid. The interest rate that the issuer pays to the bondholders. Usually this rate is fixed throughout the life of the bond. It can also vary with a money market index such as LIBOR, or it can be even more than that. Okay. Then coupon dates. The dates on which the issuer pays the coupon to the bondholders is called as coupon dates. Then indentures and convenants. An indenture is a formal debt agreement that establishes the terms of a bond issue, while convenants are the clauses of such an agreement. Then optionality. A bond may contain an embedded option, that is, it grants option-like features to the holder or the issuer. So what we are discussing now, students, we are discussing some of the important features of bonds. Then we have convertible bond. A convertible bond lets a bondholder exchange a bond to a number of shares of the issuers of the common stock. Then exchangeable bond. Exchangeable bond allows for exchange to shares of a corporation other than the issuer. So what we discussed now, we discussed the features, bond features. The first one was nominal principal or face amount, issue price, maturity date, coupon dates, indentures and convenants, optionality, then a convertible bond and exchangeable bond. We'll understand the meaning of certain terms. First, we'll understand bond. A bond is a contract that requires the borrower to pay the interest income to the lender. The par value of the bond indicates the face value of the bond. Coupon rate. This specific rate of interest is known as coupon rate. Debenture. A debenture is a document containing an acknowledgement of debt by a company. It contains a promise to pay a stated rate of interest for a defined period and then to repay the principal at a given date of maturity. Okay, now students will understand the reasons for issuing the bonds. See, governments have no choice but to borrow when they are unable to meet their expenses from current revenue corporations. On the other hand, have a wider choice in the matter of financing their operations. For example, retained earnings, equity shares, public deposits, debentures, and so on. But they still prefer to go in for borrowing for the following reasons. See, the first reason could be to reduce the cost of capital, to gain the benefit of leverage, to effect the tax saving, then to widen the sources of funds, then it could be to preserve the control. Types of bonds, debentures. The first one what we'll discuss is convertible or non-convertible bonds. Convertible bonds are bonds which can be converted into stocks and vice versa. See, these bonds bestow a right on the holders to convert them into equities as specified by the terms of the issue. The ratio of conversion is generally predetermined. See, once converted, these bonds acquire the characteristics of equity shares. Here, the process of conversion from bond to equity of the same company on a predetermined ratio is termed as conversion ratio. Then sinking bonds. Sinking fund bonds arise when the company decides to retire its bond issue systematically by setting aside a certain amount each year for the purpose. So what we are understanding now, students, we are trying to understand the types of bonds or debentures. Now next we will understand the mortgage or secured bonds. Mortgage bonds, which creates a charge on the assets of a company, they are basically termed as mortgage or secured bonds. Unsecured or naked debentures. See, debentures, bonds which do not create a charge on the assets of a company are termed as naked or unsecured bonds. Collateral trust bonds. Bonds instead of being secured by a pledge of tangible property, as these bonds are secured by a pledge of intangibles. Next, we will study income bonds. Income bonds are bonds on which the payment of interest is mandatory only to the extent of current earnings. Joint. The loan certificates that are jointly secured by two or more companies. Joint bonds. Guaranteed bonds. Bonds may be guaranteed by firm other than debtors are known as guaranteed bonds. Then redeemable or irredeemable bonds. A redeemable debenture is a bond which has been issued for a certain period. On the expiry, the amount is repaid, and irredeemable bonds are repaid only at the time of winding up. Then participating bonds. Companies with poor credit positions issues participating bonds. They have a guaranteed rate of interest but may also participate in earnings up to an additional specified percentage. Students, after understanding the meaning of bonds, debentures, and we even discussed about the different types of bonds, now we will understand the bond value theorems. The value of the bonds depends upon the three factors, which are the coupon rate, the years to maturity, and the required rate of return or yield to maturity. On the basis of this, bond value theorems have been evolved. So now we will study theorem 1. If the market price of the bond increases, the yield would decline and vice versa. See, in the example what I mentioned over there, we have two bonds, bond A and bond B. The par value of bond A is 1000 and the par value of the bond B is also 1000. The coupon rate of bond A is 10% and the coupon rate of bond B is also 10%. Maturity of both bond A and bond B is 2 years. Whereas the market price of bond A is 874.75 and that of bond B is 1035.66, and yield is 18% of bond A and of bond B it is of 8%. You can observe in this particular example what I mentioned, even though the bonds are of the same maturity and coupon rate, the difference in the market price leads to the difference in the yield. You can see that bond A, the market price is 874.75 and bond B, the market price is 1035.66. So, theorem 1 states that if the market price of the bond increases, the yield would decline and vice versa. Right, students? So, what we can conclude from this particular theorem? The bond with the low price has high yield. Please understand, I am repeating once again. The bond with the low price has high yield because with lesser amount of money, more return is earned. Please understand that. With lesser amount of money, more return is earned. Okay. So how we can conclude or what we have understood from theory, this theorem 1, students? Even though the bonds are of the same maturity and coupon rate, the difference in the market price leads to difference in the yield. The bond with the low price has high yield because with lesser amount of money, more returns will be earned. Okay. Okay, students, after understanding theorem 1, now we will understand theorem 2. If the bond's yield remains the same over its life, the discount or premium depends on maturity period. So what do you mean by this? As you can see in the example over there, See, please understand, in the first column what I mentioned is particulars, and the second column is bond A, and the third column is bond B. Okay. See, par value of bond A is 1000, par value of bond B is 1000. Coupon rate of both the bonds, that is A and B, will be 10%, and yield also remains the same of both bond A and bond B, that is 15%. Whereas if you can see over there, the maturity period for bond A is 2 years, and the maturity period for the bond B is 3 years. The market price of bond A is 918.71, with the market price of bond B is 885.86. So the discount is 81.29 for bond A, and for bond B it is 114.14. So what we can understand from this particular table, students, the bond with the short term to maturity. So in this example, the short term to maturity is short term to maturity sells at a lower discount. That is in the example bond A, which is maturity period is 2, and than the bond value with the longer time to maturity. See, if the bond yield remains the same, over the life, that is discount or premium depends upon the maturity period, right? So this is about theorem 2. So what we can conclude from theorem 2, students, the bond with the short term to maturity sells at a lower discount than the bond with the long term to maturity. Please understand this. Next we'll understand theorem 3. If a bond yields remain constant over its life, the discount or premium amount will decrease at an increasing rate as its life gets shorter. Now consider a bond with a face value of rupees 1000 and maturity period of 5 years with 10% yield to maturity. See, as you can see there, years to maturity when it was 5, present value at 10% it is 0.621. When it becomes years to maturity is 4, 0.683. Like that, year to maturity is 1, it is 0.909. So the above example shows the discount rate declines when the bond approaches to maturity. Next, the theorem 4 as well as theorem 5 you understand. Theorem 4 states that a rise in the bond's price for a decline in the body of bond's yield is greater than the fall in the bond's price for a rise in the yield. See, theorem 4, if we try to understand, a rise in the bond's price for a decline in the bond's yield is greater than the fall in the bond's price for a rise in the yield. See, for example, take a bond of 10% coupon rate, maturity period of 5 years, with the face value of rupee 1000. Then if the yield declines by 2%, that is to 8%, from 10% it declines to 8%, then the bond price will be 1079.87. Right. Next, theorem 5. The change in the price, that is the higher the coupon rate on a bond, the smaller is the percentage change of price for any change in yield. So what do you understand by that? The change in the price will be lesser for a percentage change in bond's yield if its coupon rate is higher. So these are some of the theorems. After understanding some of the basic theoretical concepts related to bonds, different types of bonds, and the theorems related to bonds, now we will start solving the problems related to calculating the price of a bond. See, the first problem what they have mentioned there, consider a 10-year 12% coupon bond, the par value of rupees 1000. If the required yield on this bond is 13%, what is the value of the bond? So first, students, whenever they give question, kindly list down the given data. Even in the examination, you have to do it in the same way. First we have to list down the given data, then we will understand the problem better. See, first what they have given, coupon interest rate they have given, that is 12%. And what is the maturity of the par value of the bond? That is 1000. So 12% of 1000 is how much? That is 120. So the coupon interest rate is 12%, that is equal to 120. And the number of years is how much? What they have given? 10 years. Consider a 10-year 12%, right? So n is 10 years. And then the maturity of the par value is equal to, they have clearly given 1000. So given all this data, now we have to calculate the price of the bond. So how do we calculate the price of the bond? Using the formula, price of the bond is equal to C, that is coupon interest rate, multiplied by present value interest factor, annuity, rate of interest, and number of years, R and N. See, we need to use the tables for this, okay? So PVIFA table we have to use it, RN plus maturity value, that is M, multiplied by PVIF R comma N. Now if we continue, students, what is C over there? They have, what we have listed in the given data, 120 multiplied by PVIFA R comma N. So what we have to see? We have to see the tables. In the examinations also, students, the table will be provided. Okay. So if you see the R and N, see R value, that is the number of years, will be given in the vertical column, and the interest rate will be given in the horizontal way. Okay. So if you have to see R, that is, what is R? 5%, and N is how much? 10. So it comes to around how much? 5.4262. 5.4262. Clear, students? Plus 1000 multiplied by PVIF, present value interest factor of R. R is how much? The required rate on the bond is, that is 13 and 10, correct? That is equal to 0.2946. So the price of the bond is equal to 945.74. Nearly I can make it equal to 946. Clear, students? So in the examination, the tables will be provided. So we have to take present value interest factor annuity table as well as PVIF table. Okay. Now after understanding the problem 1, next we will go to the second type of problem. Okay, now we will discuss the second type of problem. What is the value of the bond which is issued at 1000 rupee? So calculate the price of the bond if the coupon rate is 10%, maturing after 8 years. The required yield is 12%. So first, as I mentioned to you in the examination also, we have to list the given data. So the price or the par value is equal to how much they have given? Sorry, the coupon interest rate is how much? 10%. That is 10% on what? 10% on 1000, which is equal to 100. N is how much? 8 years they have mentioned. Then the R is how much? 12%. Right? But one more thing what they mentioned is the value of the bond which is issued at 1000 rupee. So now, how do you calculate the price of the bond? C multiplied by PVIFA R comma N, that is R in this case is 12 and N is how much? 8. And similarly plus M multiplied by PVF R comma N. So 100 multiplied by PVIFA R comma N, that is 4.9676, plus 1000 multiplied by PVIF R comma N, that is 12 and 8, which is when we see the table we get the value equal to 0.4039. So the price of the bond is equal to 900.66. So when coupon rates are received half annually, suppose in the problem if they give semi-annually, so how we calculate the bond value? See, per price, that is the price of a bond is equal to C divided by 2. Why? See, it is very simple. Semi-annually, that is yearly, twice the coupon interest will be paid to the bond holder, right? So C divided by 2, it will become multiplied by PVIFA R. So R also divided by 2. And how many times will be receiving the interest, the coupon interest? 2 times. So 2n. Please understand, students. C divided by 2 plus PVIFA R divided by 2 comma 2n. Similarly, plus M into present value interest factor R divided by 2 comma 2n. So next we will solve the problem related to this. Okay. The next type of problem, students. The question is 100 par value bond bearing coupon rate of 12% will mature after 5 years. So what is the value of the bond if the coupon interest payable is annually as well as semi-annually? So annually they have mentioned that is 16%, right? So annually is very simple, students. That is C multiplied by PVIFA R comma N plus M multiplied by PVIF R comma N. So 100 par value bond and the coupon interest rate is 12%. So first we have to list the given data, that is equal to 12 multiplied by PVIFA R, that is for R comma N plus M multiplied by PVIF R comma N, which I got the value to be equal to 86.90. This is for what? This is annually. And similarly, when we solve for semi-annually, 6 multiplied by PVIFA R comma N, as you can see, it is 16 divided by 2, which is equal to 8%. And similarly, what we have to do? 5 multiplied by 2, for how many years? 10 years. Why I have divided 16 divided by 2? Because it is paid semi-annually. Please understand that. And since it is paid semi-annually, that is yearly twice, so N is multiplied by always, that is 2, right? And if it is quarterly, students, what you have to do? We have to multiply N by N into 4. Okay. So when I do semi-annually, 6 multiplied by 6.7101 plus 100 multiplied by 0.4632, which is equal to 86.58. What I request all of you is, whenever I am explaining the problems here, whenever you are listening to this, keep on solving in your notes also. So that what happens is, you will be having a practice on that. Simply if you listen to this, then without practice, then probably you might forget, right? So please, whenever you are listening to this, keep on solving in your notes, okay? But before solving, what I request you to use the scientific calculator, that is Casio FX82MS, okay, which is allowed in the examination, as well as the tables are also provided during the examination to calculate the PVIFA as well as PVIF, okay? Next, we will understand the YTM of a bond. Students, this is one of the important concepts in this YTM, in this bond unit 3. The concept of yield to maturity is one of the widely used tools in bond investments management. See, YTM is the single discount factor that makes present value of future cash flows from a bond equal to the current price of the bond. YTM is the rate of return which an investor can expect to earn if the bond is held till maturity. So normally, students, the yield to maturity is calculated based on the certain assumptions. There should not be any default. Coupon and principal amount should be paid as per the schedule. The investor has to hold the bond till maturity. All the coupon payments should be reinvested immediately at the same interest rate as the same yield to maturity of the bond. See, understanding this is crucial for better investment decision. Any difference in the reinvestment rate will cause a difference between the actual return and the YTM. The YTM is only a measure of yield. It cannot be regarded as a measure of return from a coupon paying bond. The YTM concept has a slightly different meaning when compared to zero coupon bonds, also called as ZCB, popularly known as deep discount bonds, that is DDB. The zero coupon bonds do not carry any coupon but are issued at a price discounted to the face value. On maturity, these bonds are redeemed at face value. Since these bonds do not have any coupon payments during the life of the bond, the question of reinvestment of coupon payments does not arise at all. So there is no reinvestment risk for zero coupon bonds. So what do you understand by YTM now? It is a discount rate that makes the present value of cash flows receivable from owning bond, which is equal to the price of the bond. So YTM can be calculated using YTM is equal to C, that is coupon rate, plus M minus P divided by N whole divided by 0.4 into M plus 0.6 into P. Okay, please remember this formula. And students, as and when we encounter such formulas, please write it in your notes and put a box so that we can remember these formulas whenever we are encountering the problems related to this. Okay. Next, we will solve one problem related to solving the YTM of a bond. The next problem, consider a 1000 par value bond carrying coupon rate 9% maturing after 8 years. Bond is currently selling for rupees 800. So calculate the YTM of the bond. First we will list the given data, students. The coupon interest is 90 because 9%. So 9% multiplied by 1000, which is equal to 90. And N is 8 years what they have given, and R is 9%. So how do we calculate YTM? C, 90 plus M minus P. M is how much? It's a 1000 par value bond, right? So 1000 minus 800, that is P, okay, divided by 8 whole divided by 0.4 into 1000 plus 0.6 into 800. So we get the YTM of a bond, which is equal to 13%. I am repeating once again, students, as and whenever you are listening to this problem or whenever you are seeing this particular video, I request all of you to solve the same thing in your notes. You are simply seeing this video, then it's of no use, students. Parallelly, you have to solve the problems in your notes also. And whenever we are encountering the formulas, make sure that you write it and put a box so that we will be remembering these formulas throughout this particular subject. Okay. So after calculation of YTM, now we will understand the realized yield to maturity, also called as RYTM. See, if reinvestment rate changes for future cash flow, the realized YTM has to be calculated. That is, if the reinvested future rate has to be invested at different rate of interest. Please understand this. So RYTM is equal to price of the bond multiplied by 1 plus R to the power N. N is number of years, which is equal to the future value of the bond. Okay. So RYTM, how do we calculate it? Which is equal to price multiplied by 1 plus R to the power of N, which is equal to future value. Okay. Now we will solve one problem related to realized yield to maturity so that you can understand the concept in a better way. Market price of 1000 par value bond, which has a coupon rate of 14%, maturing 5 years. Present value bond, that is 1050. The future value of the bond is 1925.40, that is 1925.40. Calculate the realized YTM of the bond. So first, as I mentioned to all of you, when you note down the question in your notes, in the investment notes, first we have to list the given data. What they have given: price, that is equal to 1050, future value, that is 1925.40, that is 1925.40, and the number of years is 5 years. So we need to calculate the realized YTM of a bond, which is equal to 1050 multiplied by 1 plus R to the power N, which is equal to 1925.40. Now please understand carefully what we have. What we want. We want the value of R, right? So 1050 multiplied by 1 plus R to the power 5 is equal to 1925.40. So 1 plus R to the power 5 is equal to, from left hand side, whatever is there, that is 1050, it will come to the denominator of the right hand side. Okay, so 1925.40 divided by 1050. So 1 plus r to the power 5 is equal to 1.83, and 1 plus r is equal to 1.83 to the power 1 divided by 5. See, exponential, if something is there on the left hand side, if I want to bring it to the right hand side, it will become a fraction. Please understand this, students. These are very basics. Okay. Say for example, x to the power of n is equal to y, then x is equal to y to the power 1 divided by n. The same concept I have used here. Okay. So after bringing the exponential, that is 5 to the right hand side, it will become 1 divided by 5. Now r is equal to 12%. So my realized yield to maturity in this problem, what I have calculated is 12%. Okay. We'll solve one more problem related to the calculation of realized yield to maturity. So what they have given in the question is market value of 1000 par value bond, which has a coupon rate of 12% and the maturing after 6 years. So value of the bond is 1075 and the future value of the bond is 1975.3. So calculate the realized yield to maturity of a bond. See, first we will list the given data, students. Coupon rate is 12%. P, the value of P is 1075 and future value is 1975.3. So number of years is 6. So we will calculate down a realized yield to maturity RYTM, which is equal to 1075 multiplied by 1 plus r to the power of 6, which is equal to 1975.3, that is 1975.3. So what happens in the next step over there? Please carefully observe. 1075 multiplied by 1 plus r to the power of 6, which is equal to what I want the value of r over there. So what I do, 1 plus r to the power of 6 is equal to 1975.3 divided by, so what is there on the left hand side will become my right hand side's denominator, right? So 1075 will come to the denominator. So 1 plus r to the power of 6 is equal to 1.83. So 6, whatever is there, that is exponential. From left hand side, if I get to the right hand side, it will become fraction of that. So it will become 1 divided by 6. So 1 plus r is equal to 1.105. Similarly, r is equal to 1.105. So this 1, when it comes to right hand side, will become minus 1. That is, r is equal to 1.105 minus 1. So r value is equal to 10%. So in this problem, the r value what I got is equal to 10%. That is the realized yield to maturity. Okay. So after understanding how to calculate the price of the bond, then we even understood to calculate the realized yield to maturity and the YTM of a bond. So now we will understand, now we will go for equity valuation, students. So first we will understand the dividend discount model. So according to this model, the value of equity share is equal to the present value of the dividend expected from the ownership. So what do you mean by dividend? So as and when the company makes profit, it will be distributing the profits in the form of dividends to all the shareholders equally. That is very important. Okay. So expected from the ownership plus the present value of equity share when it is sold. See, there are certain assumptions for this particular model, that those are like dividends are paid annually and the first dividend is received 1 year after the equity share is bought. See, there are single period valuation, there is multi-period valuation. How to understand in the problem, I'll explain you that, but first we'll understand the formula for this. In case of single period valuation, student, the price of a equity share is equal to D divided by 1 plus R plus P divided by 1 plus R. The current rate as well as the expected rate. What you are seeing, the R in the denominator over there. And similarly for multi-period valuation, the zero growth model, P is equal to simply D divided by R, where as you can see over there, the growth rate will be 0. So the price of the equity share is simply equal to dividend divided by the rate of return. Then we have constant growth model. That means the growth is constant. So in this case, the price of a equity share is equal to dividend divided by R, that is the rate of return minus the growth rate. Here the growth rate will be constant. Okay. So the first type of problem what we will be solving now is related to single period valuation. See, students, whenever we are solving the problems one by one, So it will be easy for you. But during your examination or your assessment, so whenever the problem arises or comes in front of you, it will become challenging for you to understand what type of formula to be used. So only I'm telling you, whenever I'm making you the concepts understand now, so you need to solve the problems parallelly whenever you are seeing this particular video, and please make a box for this formula. Okay, the first problem we will take related to the equity valuation. We will solve problem related to single period valuation, students. ABC equity share is expected to provide the dividend of rupee 2 and fetch a price of 18 a year hence. So what price would it sell at 10% if the required rate of return is 12%? Please understand the problem. First we'll list the given data. So dividend is 2 rupee, so D is 2, R is 10%, which is equal to 0.1. That is, we have current rate as well as the expected rate. Okay, then they have given, that is the required rate of return equal to that is 12%. Sorry, here I mentioned 20%. It should be 12%. And price of the equity price is also 18 rupee. What they have given, right? So we have to calculate what is the CMP of that is current market price of that particular equity share. So 2 divided by 1 plus 0.1 plus price, that is 18 divided by 1 plus 0.12. So 2 divided by 1.1 plus 18 divided by 1.12, we get, that is the price of ABC company to be equal to 17.88. Okay, so this is how we calculate using single period valuation when the current rate and the expected rate of return is provided. Okay, and even the dividend is rupee 2 in this particular problem. Clear, students? Next we'll go to the second type of problem. This problem is related to constant growth model. See, in the question they'll give a small understanding, a small hint, so that you can understand and apply the suitable formula. See, X Limited expects dividend to grow at 6% per annum. The dividend expected here is 2 rupee. So what price will you pay if your required rate of return is 14%? So what they have given us in the problem, the data. So D is equal to 2 and the growth rate is 6% per annum and R is equal to 0.14. So I use the constant growth model, that is price of a equity share is equal to dividend divided by R minus G. So which is equal to dividend, they have given 2 divided by R. R is how much? 0.14 minus growth rate is constant 0.06. See, 6% divided by 100, which is equal to 0.06. Don't get confused over there. If you make 0.6, then it will be 60%. Your entire answer is wrong. So it has to be 0.06. So the price, I got the value of X Limited, which is equal to 25 rupee. Clear, students? So again I am repeating to all of you, whenever you are seeing this video, you have to solve parallelly along with me. Okay. Next, XYZ company is expected to provide a dividend of rupee 4 and price is 24 a year hence. So what price would it sell at 15% if the investors required rate of return is 12%? So what they have given us, dividend they have given, that is 4. They have given us 2 rates of return over there. You can see in the problem. What price would it sell at 15% and the investor required rate of return is 12%, right? So what I'll do, so I use which model here, students? Single period valuation. So D divided by 1 plus R plus P divided by 1 plus R. So I use it 4 divided by 1 plus 0.15 plus 24 divided by 1 plus 0.12. So the price of XYZ company I got in the solution as 24.89. Okay, students, then we'll go to the next type of model. Next we'll understand, students, the two-stage model. See, in the two-stage model, it is assumed that the extraordinary growth rate will continue for the certain period of years and thereafter the normal growth rate will prevail indefinitely. See, there's one more formula for the two-stage model. So as and when we are encountering, we have to remember these formulas, okay? So how do we calculate the price of a equity share over there? So price is equal to, for your understanding, I have mentioned D multiplied by 1 minus 1 plus G1, that is growth rate in first stage. For your understanding, I have written G1 over there, okay, to the power n divided by 1 plus R. The formula still continues, plus dividend multiplied by 1 plus G1 to the power n minus 1, right? Suppose if they have given 2 years, then 2 minus 1, that will become exponential as 1 into 1 plus G2, that is the growth rate in the next year, that is the second year. Because two-stage model, what it says, the two-stage model, it is assumed that the extraordinary growth rate will continue for certain period of years, and thereafter normal growth rate will prevail indefinitely, correct? So please understand the formula so that you can easily remember whenever the problem comes. So dividend multiplied by 1 plus G1 multiplied by to the power n minus 1 multiplied by 1 plus G2 whole divided by R minus G2. Why R minus G? Because the growth rate will be constant right after this. So R minus G2 multiplied by 1 divided by 1 plus R to the power n. So this much divided by R minus G1. Clear, students? So after understanding this particular formula, so now we will solve the problem related to two-stage model. Okay. So for your better understanding, I have used even this also, students, in two-stage model. So G1 is what? Growth rate in period 1, students, and G2 is growth rate in period 2. So N is what? Number of years, and R is the expected rate. So how do we calculate the dividend over there? So D1 is equal to D0 plus D0 into G1, that is the growth rate in period 1. Please understand that. Okay. So the first step in solving the problem is, first we have to calculate the dividend in year 1. Okay. Okay, students, we will take up the problem related to two-stage model. The current dividend of ABC Limited is 2 rupee. So ABC is expected to enjoy an above normal growth rate of 20% for a period of 6 years. Thereafter, the growth rate will fall and stabilize at 10%. So here you can see G1 and G2 in the problem. So investor required rate of return is 15%. What is the intrinsic value of the share? That is the question what they have asked. Please understand. So what all parameters they have given in the problem? Dividend they have given 2 rupee. G1 is 0.2, that is 20%, 0.2. N is 6 years. G2 is 0.1, that is 10%. And R is how much? 0.15 or 15%. Right, students? So first step is what? Step 1. We'll first calculate dividend 1, that is D1. Okay. So we'll see the solution now. So as I mentioned to you, all of you, see in the problem, whatever the given data is there, first we'll list it out. Dividend is 2 rupee, G1 is 0.2, G2 is 0.1, R is 15%, that is 0.5. So these are some of the data what they have given in the problem which we have listed. Now the step 1 is what? We have to calculate the dividend, that is D1, which is equal to D0 plus D0 into G1, which I got the value to be equal to 2.4, which I will be using throughout my problem. Alright. So now step 2 is what? Whatever the given data is there, whatever we have listed, whatever we have identified from the problem, we will be just putting those values to the formula. So to solve this problem, what is important, students? We need to understand, first we need to identify the two growth rates over there, that is G1 and G2. Then we will come to know that this is a two-stage growth model. How we will come to know that even in the problem over there, the growth rate will fall and stabilize at 10%, right? So G1 they have given, G2 they have given. So step 2, what we have done here, we have solved using the formula, that is 2.4 multiplied by 1 minus into 1 plus 0.2 to the power 6 divided by 1 plus 0.15 plus, if you miss even a single sign over there, if you miss even a single value over there, the final answer, the final price of a particular equity share will be wrong. So whenever you are extracting the data, make sure that you are doing it perfectly. Okay. So if I continue, 2.4 multiplied by 1 plus 0.2 to the power, here see, n minus 1 is there, that is 6 minus 1, that is 5, multiplied by 1 plus 0.1 divided by 0.15 minus 0.1, that what is that, r minus g, multiplied by 1 divided by 1.15 to the power 6 divided by, that is in the first part, 0.15 minus 0.2. So if I carefully keep on solving each parameter over there, I get the price of the equity share, that is price of ABC Limited, to be equal to 70.45. Please understand, you should solve along with me in the sense, when you are watching this video, the same thing should be recorded in your notes also, students, okay? Now after understanding how to solve the price of a bond in the two-stage growth model, we will solve one more problem related to the same model, okay? Okay, the next problem, the current dividend of an equity share Rolcha company is ₹3. Rolcha Limited expected to enjoy above normal growth rate of 40% for 5 years. Thereafter, the growth rate will stabilize at 12%. Equity investor required rate of return is 15%. Calculate the intrinsic value of the share. Right. So as I mentioned to you, all of you, please list down the given data. So what they have given, dividend they have given, that is equal to 3. G1 they have given 0.4. N is 5 years. G2 is 0. How much? 12. R is required rate of return, which is equal to 0.15, that is 15%, right? So first we will calculate D1, that is equal to 4.2. That is 3 plus 3 into 0.4, which is equal to 4.2. This is the first step, students. If you forget this step, your entire answer will be wrong, okay? Then whatever data we have listed, we have to put that data in the formula to get the price of the Rolcha Limited. So price is equal to how much? 327.4. Whatever data we have listed, we have to carefully entering in the formula. We have to enter in the formula in such a way that we get the correct value. Okay. See, students, for this problems, you need to solve it very often. You have to practice it more. The formulas also, if you practice more, then probably in the examination or throughout your career, throughout your life, you will not forget these formulas. So, but understand when to apply which formula. Okay. First, understand the question, list out the data. Then, whatever data they have given, you will basically understand what model we have to use it. When two growth rates are there, so you need to use two-stage growth model. Okay. Right, students? So, in this problem, we got the price of the share to be equal to 327.4. Okay, after solving the two-stage growth model problems, now we'll understand H model. See, the two-stage model has unstable initial growth rate, which can be either positive or negative. The H model has a mission growth rate that is already high, then the decline to stabilize growth rate over time. This model assumes that the company dividend payout ratio remains constant, which is the biggest downfall. See, as you can see over there, students, I have plotted a graph over there. In the x-axis, we have number of years, and in the y-axis, we have plotted the growth rate. So always remember GA is greater than GN. Okay. So GA is how much? If you can see over there, it reaches at this particular stage. Okay. When it touches GA in the y-axis, it will start declining and it falls to 2H years. So after 2H, the growth rate becomes GN, which you can see in the graph over there, students. After 2H, the growth rate will become GN. So at H, you can see in the y-axis over there the number of years, students. At H, the growth rate will be exactly between GA and GN. Okay, so this is what we call it as H model. So the first stage, what happens? We have extraordinary growth rate, then constant stage or stability stage. There is no much fluctuation. Then GN, that is growth rate in N stage, is the normal long run growth rate, and GA is above normal growth rate, what you are seeing in the graph over there. And H, that is in the x-axis, what we have H, it is halfway of GA and GN. So half of the period during which GA will decline to GN. So this is called as H model. So in the next slide, we will see the formula to be used during this particular model. Okay. So students, when we saw H model, the formula to be used, or how do we calculate the price of a equity share during this H model, which is equal to dividend, that is D naught multiplied by 1 plus Gn divided by R minus Gn. So what is Gn over there? It is a normal long run growth rate, okay, plus D naught multiplied by H into Ga minus Gn. So what is Ga over there? Above normal growth rate divided by R, that is the rate of return minus Gn. Okay, so the denominator in both the cases remains R minus Gn. Right students, so please understand this formula in H model. Then we will understand the multi-stage dividend discount model. This model is an equity valuation model that builds on the Gordon growth model by applying variant growth rates to calculation. So after understanding the H model, we will solve the problems related to H model. I request all the students to solve the problems along with this particular video, and more you do the practice, more and more you understand the concepts. So I request all of you to practice more, students. So we'll take one example of the problem related to this. The current dividend on equity share of the Crane Software Limited is ₹3. The present growth rate is 50%. Okay. However, over a period of 10 years and then stabilized to 12%. What is the value of the share if the required rate of return is 16%? So as I mentioned to you earlier also, we have to first chalk down the given data so that we'll understand the exact data what they have given. Okay, then we can apply the same thing to the formula over there. So dividend is 3, GA is 0.5, that is 50%, GN is 12%, that is 0.12, the rate of return is 16%, that is 0.16, and N is 10 years, right? So what is the price of equity share? How do you calculate? Dividend multiplied by 1 plus GN. So that is 3 directly plus 0.12 divided by 0.16 minus 0.12 plus 3 into 5. So why it is 5? Since N is 10 years, so H is what? Halfway of GA and GN. So half of the number of years. So 10 divided by 2 is equal to 5 multiplied by 0.50 minus 0.12 divided by 0.16 minus 0.12. I get the price of a equity share to be equal to 226.5, which I'll see, which you can see the calculation in the next slide. Please solve along with this particular video in your notes also. So in the previous slide, we have listed the given data. Then the price of the equity share using H model, I got the value to be equal to 226.5. Okay, clear, students? The current dividend of Kane India Limited is ₹4. The present growth rate is 20%. It will decline linearly for a period of 8 years and then stabilize at 10%. So what is the intrinsic value of the share if the required rate of return is 18%? So first we will list the given data in the problem. So D is equal to 4, GA is 20%, that is equal to 0.2, N is number of years, that is equal to 8, GN is 10%, that is equal to 0.1, 10%, and R is 18%, which is equal to 0.18, and N is the number of years, which is equal to 8. But in the problem, when I say H is equal to 8 divided by 2, which is equal to 4, right? So how do we calculate the price of a equity share here? So I apply the data which I have collected or which I have gathered from the question to the formula, which is equal to 4 into 1 plus 0.1 divided by 0.18 minus 0.1 plus dividend 4 into 4, right? 4 is what dividend, and H value is what 8 divided by 2 is equal to 4 into 0.2 minus 0.1 divided by 0.18 minus 0.1. I get the price of the equity share is equal to 55 plus 10, which is equal to 65. Clear, students? Okay, next we'll solve the problem. I'll repeat the question. Please kindly note it down in your notes also, students. The current dividend of Pfizer company belongs to pharma sector for your information, student. Just an example. This question is just an example. is rupee 5, the present growth rate is 50%, then the growth rate will decline for a period of 16 years. See, H is what? 16 divided by 2, which is equal to 8 years, and stabilize it 10%. So what is the intrinsic value of the share if the required rate of return is 18%? So as I mentioned to earlier, first we have to list down the given data. So dividend is how much? 5 rupee per share. GI is 0.5, GN is 0.1, R is 18%, and N is what? 16 years, and H is how much? 16 divided by 2, which is equal to 8. So if I apply all these values to the formula over there, I get the price of the Pfizer company to be equal to Pfizer Limited to be equal to 268.75. So please understand, students, whenever you are collecting the data from the question, make sure that you read the question once or twice or thrice so that you collect the exact data. Then after that, when you collect the data, you should carefully place that data to the formula. Then only you will get the exact value. Even if you miss a single decimal point, your price of a equity share, the ultimate solution or the ultimate answer will be something different. Okay, so you should be very careful while solving this type of problems. And when you solve more and more problems, or if you do more and more practice, so you will be well versed with these problems. Okay, the moment you see the question, you will be understanding, okay, which model to be applied. Right, students? Next we will solve the expected dividend per share. I'll read out the question. The expected dividend per share of the company Lupin. Lupin again is a pharma sector stock. Okay, is rupee 10. The dividend is expected to grow at 5% per year, and the price per share is 80%. So what is the expected return on the company, that is Lupin Limited? So what parameters they have given to us, or what data they have informed to us in the question? We'll first list it out. So dividend, what they have given is 10. G is how much? 0.05, that is 5%, and price is how much? 80, and R is how much? That is the expected rate of return. They have given to be equal to R. See, in this question, R whether they have given? No, they have not given. That means what they have given? They have given the price, they have given the dividend, they have given the growth rate, which is constant. So we have to calculate the expected rate of return, right? So R is what? Question mark. See, students, out of this 4, that is price, dividend, return, and growth rate. So even if one data is not there, we can, using this 3 data, we can calculate any one data. Okay. So please understand that. So price they have given to be equal to 80 is equal to 10 divided by R minus 0.05. So what is there? On the left hand side we have 80, and on the right hand side we have 10 divided by R minus 0.05. So we have to calculate the value of R. So what we do? So whatever is there on the right hand side, that is R minus 10 divided by R minus 0.05, I multiply that with 80. So 80 multiplied by R minus 0.05 is equal to 10. So 80 R is equal to, I take whatever is there on the left hand side to the right hand side. So 80 R is equal to 10 plus 80 into 0.05. Then I need to calculate the value of R, right, students? So carefully what I do on the left hand side, R is equal to 10 plus 80 into 0.05 divided by 80. So I get the value of R, that is expected return on Lupin Limited, to be equal to 0.17, or it is simply equal to 17%. Please understand, students. Okay. So out of this 4, that is dividend, price, rate of return, and growth rate, even if one data is not there and if they have given you all the remaining 3 data, then easily we can calculate the 4th data using the 3 data, right, students? So we'll just understand whatever the concepts we have studied once again. 2-stage growth model. In the constant growth model, it is extended to 2-stage growth model. Here the growth rate stages are divided into 2, namely a period of extraordinary growth rate, what we have discussed earlier also, students, and a constant growth rate period of infinite nature. The extraordinary growth period will continue for some period, followed by the constant growth rate. The information technology industry is at present experiencing an extraordinary growth rate. It may continue for some time, and afterwards it may maintain a constant rate. Okay. Now we'll understand the 3-phase model also, students. So here in the 3 phases of dividend growth pattern, that is dividend growth pattern is assumed. Dividends are assumed to grow at a constant rate, that is GA, for a period of A years. What you can see in the graph over there, that is time is plotted in the x-axis and the growth rate is plotted on the y-axis, right? So after the phase A, the growth rate of dividend declines for A plus 1 years throughout the phase B, and the decline in the dividend rate would be linear. So afterwards, there would be a perpetual growth rate, that is GN. Sometimes the growth rate, that is GA, would be less than GN, what we can see in the diagram over there, that is the graph over there. And in the second phase, there would be linear growth rate. The perpetual growth rate is known as the firm's long run normal rate, growth rate. So how do we calculate the price of equity share using the three-phase model? So summation of, please understand the symbol over there, summation of that is T is equal to 1 to A, that is the time period, D naught plus 1 plus GA to the power T divided by 1 plus R to the power T, plus summation of T is equal to A plus 1 to B. So dt minus 1 to the, multiplied by 1 plus GB divided by 1 plus R to the power T plus D, that is dividend, into 1 plus GN divided by R minus GN multiplied by 1 plus R to the power B. Okay. So where, please understand some of the items over there. Dividend is D naught is the next year dividend, GA is the period A growth rate, GB the period B growth rate, students, and the GN is the growth rate in the third phase. See, there will be three phases here, like GA, GB and GN, okay, and the DB is the dividend at the beginning of the third phase, right, students? Now we will solve a problem related to the three-phase model also, okay. Okay, I'll read out the problem, students. For the first 4 years, XYZ firm is assumed to grow at a rate of 10%. After 4 years, the growth rate of dividend is assumed to decline linearly to 6%. After 7 years, the firm is assumed to grow at a rate of 6% indefinitely. The next year dividend is ₹2 and the required rate of return is 14%. See, they have asked us to find out the value of the stock. So this problem will be solving in 4 steps. But before this, we have to understand that it's a three-phase growth model, since there are GA, GB and GN what they have given, right? So first we have to understand the formula. So I'll note down the formula first. Summation of T is equal to 1 to A, D naught multiplied by 1 plus GA to the power T divided by 1 plus R, plus summation of T is equal to A plus 1 B dt minus 1 into 1 plus GB divided by 1 plus R, plus dB, that is the dividend at the beginning of the third phase, multiplied by 1 plus GN divided by R minus growth rate into 1 plus R to the power B. Okay. So as I mentioned to you, first we have to list down the given data, students. So D naught is equal to 2, R, that is the rate of return, is equal to 0.14, GA is equal to 0.1, then dB, that is declining rate of return from 10% to 6%, that is 0.09, 0.08, 0.07 and 0.06. What we have to consider in the problem. Then GN is equal to 6%, that is 0.06, and B. So in the question they have mentioned that after 7 years the firm is assumed to grow at a rate of 6% indefinitely. So what is the value of B over there? 7 years, that is the beginning of the third phase, right, students? Now we will solve the step 1. We will solve, there are 4 steps to solve the three-phase growth model. First we will solve step 1, then finally we will go to step 4, okay? So in step 1 what I do is, I only consider the part of the formula, that is summation of T is equal to 1 to A, dividend multiplied by 1 plus growth rate divided by 1 plus R, okay? So first, 2, so when I say summation, it is for the 0th year, okay? 2 into 1.1 to the power of 0. Please understand, students, anything to the power of 0 is equal to 1. Please understand this. So 2 multiplied by 1 is what? 2 divided by 1.14 plus 2 into 1.1 to the power of 1, that is first year, divided by 1.14 to the power of 2 plus 2 into 1.1 to the power of 2, that is second year, divided by 1.14 to the power 3 plus 2 into 1.11 to the power 3 divided by 1.14 to the power of 4. So I get the value to be equal to 6.656. Okay, the first component of the formula, I got the value to be equal to 6.656. Then I go to step 2. So what is there? Solving, that is summation of t is equal to a plus 1, b, d dividend multiplied by 1 plus gb divided by 1 plus r to the power t. So which is equal to 2 multiplied by 1.1 to the power of 3, okay, multiplied by 1 plus growth rate, that is 1 plus 9%, that is 1.09, divided by 1.14 to the power 5. The right, 1 plus a rate of return to the power, how much? That is the second phase, that is 5, and parallelly 2 into 1.1 to the power 3, 1.09 and 1.08. Correct, it will be declining, right? All of you understood? It will be declining. What will be declining? The dividend at the beginning of the third phase will be declining, right? So divided by 1.14 to the power 6 and plus 2 into 1.1 to the power 3 multiplied by 1.09 multiplied by 1.08 and 1 multiplied by 1.07 divided by 1.14 to the power 7. So I got the value to be equal to 4.2746. Right, students? Then I take the third component in the formula in the next slide. So step 3, I calculate, that is dp, that is dividend at the beginning of the third phase multiplied by 1 plus gn divided by r minus gn into 1 plus r to the power b. Okay, I extract the third component from the formula. So 2 multiplied by 1.1 to the power 3 multiplied by 1.09 multiplied by 1.08 multiplied by 1.07 multiplied by 1.06 whole divided by r minus gn, that is 0.14 minus 0.06 multiplied by 1 plus r to the power b. So that is 2.5023. You have to parallelly solve in your notes, students. Don't simply write these values over there, okay? You have to solve the problem over there carefully on your own when you understand this, and match with the values, which is equal to, I got the value to be equal to from step 3, that is 17.7611. Okay, so step 4, what I did, I add all the components to get the price of a equity share. So I got the price of the equity share to be equal to 28.69. So the present value of the stock, that is XYZ, is 28.69. That till here you understood, students? So the value of the stock can be compared with the actual price to take the decision on the purchase, sale or hold the stock. Clear? So the value of the equity share is 28.69. Okay, please refer the textbooks which are recommended by the university, which is mentioned in the syllabus copy. So majorly I am referring Punitavati Pandian and Prasanna Chandra, J. Kevin. Okay, you also please refer and start solving the similar problems which are already there in the textbooks. Okay, students, thank you so much for watching this video. So we have understood the concepts of bond. We have even understood the various types of bonds. So we have understood the YTM of a bond, the realized yield to maturity of a bond. We have solved numerous problems related to equity valuation, starting from single period valuation, multiple period valuation, two-stage growth model and all. But how you can be understanding these problems is you need to solve it. Only practice will make you perfect, students. So as I mentioned to you earlier, so please maintain a dedicated note for investment management subject. So as and when you see this particular video, you have to solve as many as problems as you can, so that the concepts will be very strongly remaining in your mind. Okay. So I hope you have understood all the concepts what you have discussed in this particular video. So I'll be explaining you more during my Google online classes also, Google Meet online classes also, so that you can interact with me, ask more queries related to the problems. Right, students? So thank you so much once again for watching this video.